On the daily chart, SPY is locked in a remarkably narrow consolidation. Price action over the past week has oscillated within a modest 13-point band, resting above its key moving averages, yet repeatedly stalling near recent highs. This is the type of coiled spring behavior that technicians recognize as unsustainable. In such conditions, volatility is often suppressed temporarily, only to be released abruptly in the form of a directional surge. If you want these levels on your radar before the market reacts, hit subscribe. It's the easiest way to stay ahead. The daily structure reveals a familiar rhythm. Moments of sharp decline followed by swift recoveries, leaving behind patterns that appear less like anomalies and more like recurring motifs. I have highlighted several instances where price action, after a forceful sell-off, stabilized and then resumed its upward trajectory. History does not repeat perfectly, but it often rhymes, and these echoes remind us to remain attentive to precedent, even as conditions evolve. Currently, SPY is emerging from another such rhythm. The decline to 654.41 bears resemblance to prior pullbacks that ultimately served as launching pads for renewed strength. Importantly, price has reclaimed short-term moving averages, just as it did in earlier highlighted cases, suggesting buyers continue to respond vigorously at key levels of support. Momentum indicators underscore this tension. The stochastic oscillator has begun to roll over from elevated levels, while relative strength hovers in the low 60s. Neither overbought nor oversold, but positioned precariously in the middle ground. Volume patterns likewise betray caution. Turnover has thinned even as price has held aloft, suggesting participation is waning at current levels. For those leaning defensively, as I have been this past week, the challenge lies in balancing skepticism with openness. The market has not yet validated a bearish reversal on this time frame. Rather, it is offering evidence that recent weakness may represent consolidation within an ongoing trend, rather than its demise. I share these levels the moment they form. If you wait, you'll be reacting late. Subscribing means you won't miss the next setup. The prudent posture, therefore, is one of vigilance rather than bias. If the current bounce fails beneath resistance near 667.5, caution is warranted. But should price push through that threshold, the daily chart may once again rhyme with its own history, consolidations giving way to renewed advance. The implication is clear. Traders face a pivotal juncture. Sustained closes above resistance would confirm the bulls remain in command, but a breakdown beneath support could trigger a cascade as short-term holders exit in unison. On the weekly time frame, the S&P 500 presents a picture of remarkable resilience. For several months, price has held steadily above the 5-week moving average, an often overlooked but historically significant guidepost for trend sustainability. Each attempt by sellers to break this line has been met with renewed buying interest, reinforcing its importance as dynamic support. Yet beneath this surface strength, early signs of fatigue are emerging. Momentum oscillators reveal negative divergence. While price has advanced to fresh highs, relative strength has failed to confirm with new peaks. This subtle disconnect between price and momentum warrants attention, as it has historically preceded periods of corrective activity. Volume trends add further nuance. Weekly turnover has not expanded in tandem with price, suggesting that the marginal buyer may be showing restraint at elevated levels. Markets can drift higher under such conditions, but the absence of broad participation often leaves rallies vulnerable to abrupt reversals. In short, the weekly chart reminds us that trend remains intact, but the foundation supporting it is narrower than it appears. Sustained leadership from buyers is required to prevent the weight of divergence from tipping the balance. The weekly chart underscores the remarkable resilience of the current advance. Price continues to hold firmly above the 5-week moving average, a dynamic level that has acted as a persistent guide for buyers since the post-liberation sell-off and recovery. Notably, this marks the 6th doji print in the last 25 weeks, a frequency that speaks less to weakness and more to persistent indecision within a broadly rising structure. From a structural standpoint, the line in the sand remains clear. Should price advance through 6675, the uptrend is likely to reaffirm itself without hesitation. However, the possibility of another doji forming next week cannot be dismissed. In fact, the last 3 weekly candles collectively reveal a striking contraction, barely a 13-point range from high to low, extended now for nearly a month. This narrowing of volatility is not sustainable. Market history teaches that periods of range contraction are typically precursors to range expansion, a tightening coil that eventually resolves in a decisive move. The challenge, as ever, lies not in predicting whether expansion will occur, but in positioning for which direction the release will favor. On the 2-hour chart, SPY finds itself in a compressed state between Fibonacci retracement bands and short-term moving averages. Price has reclaimed the 20-period EMA, but remains capped just beneath the 61.8% retracement level at 662.4, which is a zone that often acts as the line in the sand for determining whether a bounce is merely corrective or the start of a new impulse higher. The earlier bullish trigger has been drawn from the 2-hour chart rather than the daily. On the daily time frame, price has reclaimed and closed above the 8- and 10-day moving averages, and more importantly, has retaken the 20-day at 654.18. It is noteworthy that price also finished just above the 8-day 66156, but remains marginally capped beneath the 5-day at 66220. Historically, the first test of the 20-day average often produces an initial bounce, and this instance appears no different. In hindsight, any time price tests the 20-period moving average from above, it should be anticipated that bulls will not relinquish control so easily after several weeks of strong upward momentum. From a technical perspective, the daily chart has undergone a healthy reset. The RSI 14 now stands at 63.05, pulling back from overbought conditions, while the RSI 5 sits at 57.61, leaving room for further advance if buyers press the advantage. The 2-hour chart corroborates this tension. Price is compressed just beneath its 20-period moving average, yet momentum, as measured by RSI, retains capacity to extend higher. On the weekly time frame, SPY printed a red doji, a sign of indecision rather than decisive reversal. Indeed, the possibility of another doji forming next week cannot be dismissed, particularly given that the 5-week moving average has served as steadfast support for months. However, one cannot overlook the negative divergence in weekly RSI, which remains extended into overbought territory despite the daily reset. Thus, the central question persists: is this merely a technical bounce from well-defined support, or the prelude to another push into fresh highs? My own frustration stems from having been stopped out on the second short attempt, a reminder that in the context of a strong prevailing uptrend, counter-trend trades demand both precision and restraint.